Silver shock, why $75 Oz by Christmas 2025 is now a real probability. Ladies and gentlemen, welcome to this comprehensive market analysis. Today, we are not simply reviewing a price chart. We are witnessing what may well be the most significant repricing event of a commodity in modern financial history. We are turning our attention to silver, a metal that has lived in the shadow of gold for decades, but is now stepping into the spotlight with a ferocity that has stunned institutional and retail investors alike. Specifically, we are going to dissect the extremely optimistic, yet data-backed forecast that spot silver prices could storm through the $75 per ounce mark by the time we celebrate Christmas 2025. To understand why this target is not merely a fantasy, but a mathematical probability derived from current market dynamics, we must first anchor ourselves in the absolute reality of the present moment. As of mid-December 2025, the silver market has fundamentally shifted. We have seen spot silver shatter historical ceilings, confirming a price of $66.09 per ounce as of December 16. This is not a drill and it is not a test. We are trading in blue sky territory, having breached previous records of $64.64 just days prior. To put this into perspective, this is not a gradual, gentle climb. This is a vertical ascent. Silver has posted year-to-date gains estimated between 100 and 115% since the start of 2025. It has outperformed gold by double, moving with a velocity that has caught almost every managed money position off guard. When we look at the sheer speed of this move, we see that in the last month alone, silver has rallied approximately 25%. With the price now sitting comfortably above the $66 handle, the distance to $75 is roughly 13 to 14%. In a standard market environment, a 14% move might take a year. However, we are currently witnessing daily volatility swings of up to 7.5% in a single trading session. At this velocity, the gap between the current price and that $75 target could theoretically be bridged in just 2 days of aggressive institutional buying. This is why the conversation has shifted from $75 being a 2026 story to potentially being a Christmas 2025 reality. Let's delve deep into the technical landscape, as this is where the narrative becomes incredibly compelling. We are currently seeing what technical analysts describe as a parabolic run. Veteran analyst Avi Gilbert has noted that the ideal target for this current wave is between $75 and $80. He has emphasized that whether silver hits this zone depends heavily on the market's behavior at the very end of the year. We are essentially watching a fractal repetition of the explosive moves we saw back in 2010 and 2011, but on a much larger, more violent scale. When a market goes parabolic, standard resistance levels evaporate. The psychological barrier of $75 acts as a magnet for price action, especially if the current squeeze continues through the holiday liquidity drain, a time when lower volumes can lead to exaggerated price spikes. However, technical charts are merely the roadmap, fundamentals are the fuel. Right now, silver has 2 massive engines firing at maximum capacity, creating a perfect storm for price appreciation. The first engine is the macroeconomic fear trade. Investors are scared, and the data suggests they have every reason to be. We are witnessing a deterioration in United States economic data that is becoming impossible to ignore. The recent non-farm payroll data showed a chaotic picture, with job numbers swinging wildly from losses in October to gains in November, while the unemployment rate has ticked up to 4.6%, missing market forecasts of 4.5%. Simultaneously, we are seeing signs of stagflation, that toxic economic cocktail where growth slows down but costs keep rising. Retail sales in the U.S. are stagnant, barely moving in October. Meanwhile, business activity is expanding at its slowest pace in 6 months, yet input prices, the cost of doing business, have surged to a 3-year high. This is squeezing profit margins and alarming the Federal Reserve. Speaking of the Fed, they have recently cut interest rates by 25 basis points to try and stop the bleeding. However, this monetary easing in the face of rising input costs has fueled fears of sticky inflation or even hyperinflation. In this precarious environment, fiat currency feels unsafe. Investors are rushing into tangible assets. But here is the critical nuance: gold is expensive. For many retail investors and smaller institutions looking for leverage, silver offers the same safety profile as gold, but at a much lower entry price. It is the classic poor man's gold dynamic, but with a twist. This time, the poor man's gold is generating rich man's returns. We are seeing a flood of capital entering the market not just to speculate, but to hide. When you combine fear of the dollar's purchasing power with a Federal Reserve that is forced to loosen policy to support a wobbling labor market, you create the ultimate tailwind for precious metals. If fear were the only driver, silver would simply be following gold's lead. But it is not, it is leading the charge. This brings us to the second and perhaps more durable engine, the structural industrial imperative. This is the argument that makes $75 look less like a bubble and more like a necessary fair value adjustment. Unlike gold, which is largely hoarded in vaults, silver is consumed. It is a critical industrial metal. In fact, the United States government officially designated silver as a critical mineral earlier in 2025. Why is this designation so important? Because you cannot build the modern world without silver. Consider the green energy transition. Solar panels or photovoltaic cells now consume nearly 29% of the total global silver demand. That is almost triple the consumption rate of a decade ago. Then you have the electric vehicle revolution, and perhaps most critically, the explosion of artificial intelligence infrastructure. AI data centers and hardware require massive amounts of reliable, highly conductive connectors. Silver is the most conductive metal on Earth. There is no substitute that offers the same efficiency. This creates what economists call inelastic demand. It means that major industrial players, whether they are manufacturing solar arrays or building server farms for AI, cannot simply stop buying silver just because the price rises to $75. They need the metal to make their products function. They will pay whatever the market demands. This industrial necessity puts a hard floor under the price that gold simply does not possess. We are facing a structural supply deficit that is expected to worsen as we head into 2026. We are digging less silver out of the ground, just as humanity's demand for high-tech electronics is exploding. Paul Williams, a director at Solomon Global, has noted that with silver trading above $60 and having jumped 25% in a month, the trajectory toward triple digits is clear. The shortage is real, and the market is finally pricing it in. Now let's address the concept of value. Even at $66, is silver expensive? Relative to historical nominal prices, yes. But relative to gold, absolutely not. This is where the gold-silver ratio, or GSR, becomes your compass. Historically, this ratio hovers between 50 and 60. That means it takes 50 to 60 ounces of silver to buy 1 ounce of gold. Recently, that ratio was over 80. It has since collapsed to around 68. Strategists like Michelle Schneider have pointed out that in aggressive bull markets, such as the one we witnessed in the 1970s, this ratio can crash down to 40 or even 20. If the ratio heads toward 40 and gold remains stable or rises, silver has to appreciate mathematically to close the gap. Schneider explicitly stated that if this ratio continues to fall, it implies silver prices have significant room to run, supporting that $75 target as a milestone on the way to higher valuations. The market is realizing that silver has been undervalued for too long relative to its yellow cousin. This ratio compression is a powerful signal that smart money is rotating out of overbought assets and into silver to catch up. Let us now shift our focus to the physical market, using Vietnam as a compelling case study for global tightness. The Vietnamese market often acts as a proxy for physical demand in emerging economies, and the signals coming from there are flashing red. In Vietnam, the price of silver bars has doubled since the start of the year. We are seeing major brands like SBJ and Phu Quy selling 1 kilogram silver bars at prices exceeding 64 million dong. What is particularly telling is the behavior of the premiums. the extra cash you pay above the spot price to get the metal in your hand. These premiums are expanding, indicating a shortage of physical bars. When the paper price on the exchange disconnects from the physical price on the street, it usually means the spot price has to race higher to catch up with reality. For the first time, we are seeing SBJ launch 1 kilogram silver bars to compete with existing brands, signaling that domestic enterprises are scrambling to meet a surge in investment demand. The volatility in the domestic market is extreme, with prices changing dozens of times a day, sometimes by millions of dong for a kilo bar. This chaotic pricing is a hallmark of a market in a squeeze, where supply cannot keep up with the panic buying of investors who fear missing out. Of course, we must address the risks. A market that goes vertical can come down just as fast. We are seeing volatility that can stomach churn even seasoned traders. When you have a 7.5% swing in a single day, you are looking at a market that is searching for equilibrium and failing to find it. There is always the risk of profit-taking. Institutional funds that bought in at $30 or $40 are sitting on massive gains. If they decide to cash out before the books close for the year, we could see a sharp, sudden correction. Experts have warned that a pullback to the $43 to $47 range is theoretically possible to build structure, though the current momentum makes that seem distant. Furthermore, the FOMO or fear of missing out can drive prices to unsustainable levels in the short term. We saw silver hit $64.50, then dump to $60, only to rip back up to $66 days later. This is not a market for the faint of heart. It requires a steady hand and a long-term thesis. However, the prevailing sentiment among analysts is that any correction is a buying opportunity, not a trend reversal. So bringing it all back to our central thesis, is $75 per ounce achievable by Christmas 2025? The evidence, when viewed holistically, suggests a resounding possibility. We have the momentum. The breach of $66 has cleared the technical skies. We have the fear trade driven by Fed rate cuts, rising unemployment and inflation fears. And we have an industrial complex that is structurally short of the metal it desperately needs for the future economy. Imagine the silver market right now as a coiled spring that has been compressed for decades. For years, the price was suppressed despite rising demand. Now the macroeconomic vacuum has released the tension. The industrial demand provides a hard floor, preventing the spring from recoiling downwards, while the speculative money is pulling it upwards with immense force. If you are holding a position, the recommendation from experts is to hold firm, but manage your risk carefully. The volatility will be violent, but the trend is undeniable. The $75 mark is no longer a distant horizon. It is the immediate battleground. As we head into the holiday season, keep your eyes on the liquidity. Low volume during the holidays, combined with high demand, can lead to explosive price spikes. We might just wake up on Christmas morning to find silver sitting at a price point that seemed impossible only a few months ago. Looking beyond the holidays, this move to $75 may just be the opening act. If the supply deficits persist as forecasted into 2026, and if the global economy continues to wobble, we are likely looking at the foothills of a much larger mountain, potentially a three-digit price tag of $100. Philippe Jaissels, a chief strategy officer, has explicitly stated that we are in a long-term bull market that could see silver hit three digits in 2026. But for now, all eyes are on the close of 2025. The stage is set, the players are positioned, and silver is ready for its historic curtain call. To summarize the situation for the international observer, silver is currently enjoying a dual status benefit. It is being treated as a monetary metal, a hedge against the debasement of the US dollar and the instability of the US economy. Simultaneously, it is being hoarded as a strategic industrial asset, essential for the AI and green energy revolutions. This dual demand is crashing into a wall of limited supply. The result is price discovery on a massive scale. Whether it hits $75 on December 25th or January 15th is almost secondary to the reality that the trend has changed forever. The era of cheap silver appears to be over. The repricing of this critical asset is underway, and the window to acquire it at double-digit prices may be closing faster than anyone anticipated. For the investor watching the charts this December, the message is clear: do not blink. The market is moving with historic velocity. The conditions that created the 2011 peak are back, but this time they are amplified by genuine industrial scarcity that did not exist 15 years ago. The $75 target is real. The timeline is now, and the world is watching. Thank you for joining us for this analysis.